How did Marsh achieve 8% revenue growth, hitting $7.6 billion, while global property insurance rates just dropped by 9%?
Right. I mean, it sounds like a massive math error, but looking at Marsh's Q1 2026 earnings call, it's actually a masterclass in using AI.
It really is. Hello, everyone. A warm welcome to you, and thank you so much for coming to watch the video today.
Yeah, thanks for joining us.
Today, we are breaking down that Q1 call. Our mission is to extract the core financials, look at their massive AI pivot, and really dig into the rapid-fire analyst Q&A.
So jumping right into the financials, that 7.6 billion in revenue, that 8% jump is totally real, and their adjusted EPS is also up 8%, hitting 3.29.
Which is huge. And they also detailed this THRIV program, right?
Yeah.
Targeting like 400 million in savings.
Exactly. Though you do have to factor in a pretty hefty $425 million charge for the Greensill litigation.
Right, that's a big hit. But looking at the broader market context, primary commercial rates actually decreased by 5%.
Yeah, and normally if the thing you broker gets cheaper, your revenue drops.
Oh, okay.
But Marsh is growing because they handle highly complex advisory roles, not just, basic commoditized insurance.
Which brings us to their AI pivot. They laid out a strategy to be an AI winner across 3 pillars. So there's growth, using tools like Ada and GC QuoteBox. Then productivity, which relies on these AI lead gen agents. And efficiency, turning a legacy tool into a breaker workbench in literally days.
It's aggressive, but I know a lot of people are wondering if this is actually generating revenue or if it's, well, just tech hype.
Exactly my thought. Are they just throwing buzzwords around? We're going to jump right into the analyst Q&A to answer that. But real quick, before we do, if you're enjoying this analysis so far, please click like, share the video, and subscribe to catch all our exciting content.
So getting into that Q&A, the analysts were definitely pushing them on the AI front. Greg Peters over at Raymond James kicked it off.
Right. He asked about margin expansion and the risk of AI causing disintermediation, like cutting out the broker entirely.
And Marsh's response was that they deal with complex risk financing, so AI actually enhances their moat. Oh, and they also casually noted a planned $5 billion capital deployment.
Just casual. Then Mike Zaremski at BMO jumped in, demanding specific examples of this AI value add.
Yeah, and Marsh came back with Claims IQ, which analyzes 200 billion in lost data. They also highlighted GC QuoteBox ingesting unstructured data, and Mercer Fiber doing like real-time health modeling.
Wow. Next up was Brian Meredith from UBS. He asked about client demand falling as rates decrease and how Marsh can keep those AI productivity gains.
Marsh pointed out that the actual cost of risk is rising way faster than GDP, so their bespoke services ensure they get to retain those gains.
Makes sense. Then Robert Cox at Goldman Sachs asked if AI changes their M&A strategy.
Big yes on that one. Marsh's scale allows them to consolidate smaller brokers who just can't afford these heavy AI investments.
Right. And Meyer Shields at KBW wanted to know if AI will change commission structures.
Marsh doesn't see any changes there. Fees are still just a tiny fraction of a client's overall risk costs.
Got it. Then Elise Greenspan at Wells Fargo pointed out that Kai Carpenter only saw 2% growth.
Yeah, they explained that was driven by a soft property cat market and really tough prior year comps, but they still had record new business.
Finally, we had David Moatmaden at Evercore ISI asking for AI spending details and about their personal lines exposure.
Marsh confirmed significant tech capex using multiple large language models, and they clarified their personal lines are strictly high net worth, so not direct digital targets.
Okay, so pulling this all together, Marsh is clearly leveraging massive scale and proprietary data to dominate AI. They are successfully navigating soft market pricing through highly complex advisory services.
Absolutely.
Which leaves you with a really provocative thought to mull over. If smaller brokers simply can't afford the massive AI tools required to process all this unstructured data, will the insurance brokerage industry soon become a winner-take-all monopoly?
It's definitely something to watch.
Thank you all so much for watching. Again, if you liked the video, please click like, share it around, subscribe, and stay tuned for our upcoming content. See you next time.